there's a lot of things that people need to be wary of. And it's quite easy to fall into the trap of just thinking that any old commodity is a good commodity in a super cycle. That's not necessarily the case, am I right?
No, it's actually not. There's a couple that I actually think people should be aware of. In saying that, in the last phase of a bull market, even investment decisions tend to go up. It's the mania that lifts them. You're not a genius. You're just riding the tailwind of a bull market. That's all. But but the thing with commodities is they can fall out of favor really quickly. Markets can turn on a dime. It's like, even though it takes millions of dollars and decades to get these production lines in, sentiment can change quickly. And a great example of that is...
Welcome to the Exponential Investor Podcast. Want to be a better, smarter, more clued up investor? Well, you've come to the right place. We cover the breakthrough investment ideas you don't hear about in the mainstream to keep you on top of the megatrends and opportunities reshaping our world.
Good morning and welcome to the Exponential Investor Podcast. I'm your editor, Sam Volkering, here with my co-editor, Shae Russell. Good morning, Shae. Nice to have you with us again. How's your week been so far?
It's been good. It's been a little busy. I've been working on some things and I feel like I need a good long sleep. What about you? How's the weather treating you over there in the north?
Wow, you know all about this, and I know all about this because we, come from a land down under, and summers are a bit hot down under. It's been a stinker over here, I will admit. I think it was 41 degrees, I think it topped out at yesterday, and 38 or 39 the day before. Britain is melting, and I'm sure everybody watching has survived barely the extreme heat over here. The headlines are unbelievable, Shae, as you could imagine. Climate crisis, heat crisis, why this isn't just summer, although it is. A lot of nasty stuff. But as I commented on Twitter, and I don't know what it was like for you when you were a kid, but when I was a kid growing up in Melbourne, and summer would roll around, inevitably mid to high 30s most of the time. And then on the odd occasion, 40 plus. We weren't even allowed to take our school blazers off on the way to school or on the way home from school, unless it was over 35 degrees. So I don't know. It seems like maybe people are a little bit more soft these days. What do you think?
Actually, I've got a little bit of science I'm going to throw at this for you. It's actually worse in the UK. And I say that without being there, because your houses aren't designed to let heat out. Your houses are actually designed to trap heat in, whereas Australian houses are designed to let heat out through the roof. UK houses, and I wrote about this on Thursday in Exponential Investor. Clearly you weren't paying attention. They're designed to actually trap heat in, so there's no actual airflow. So your summers inside are actually more excruciating than Australian summers outside, because our houses basically breathe. Yours don't. That's why.
It's true. It is very true. And it's like, I remember talking about this with somebody recently and saying that double-story houses in Australia, although a little bit more common now, aren't really the norm. Single level, or what they call bungalows over here, are much more common because they're much better for managing heat.
Yes.
But, anyway. As Boris Johnson would say, them's the breaks. I've got aircon anyway, so I don't give a stuff. I'm Australian, and summers, I just figured that summers are always going to be hot in this country, and houses aren't built for it, so I got aircon. And I wrote about it, funnily enough, in May. Should you buy aircon this summer? Well, I think that question answered itself this week. But anyway, we're not here to talk about the weather.
No.
Look at what you've done. You've turned me into a proper Brit. All I'm here doing is sitting here talking to you about the weather. It's ridiculous. Let's get on to more exciting things. Yes. I want to talk to you about commodities because you love commodities. And to be fair, I love commodities. We've talked about this before. It's in your blood as someone from Australia. So a couple of the things I wanted to ask you about today. I get a lot of people that write into us at EXI and some of my other publications, and we try and look for investments, stocks that are, in that sector, metals, mining. I don't look at it as much as you do. But the thing is we're always on the lookout for the winners, the good stuff. What's the next big metal going to be that I can make a crap ton of money on, which is great. That's what we're here for. We're here to help people make money. But at the same time, there's a lot of things that people need to be wary of. And it's quite easy to fall into the trap of just thinking that any old commodity is a good commodity in a super cycle. That's not necessarily the case, am I right?
No, it's actually not. There's a couple that I actually think people should be aware of. In saying that, in the last phase of a bull market, even investment decisions tend to go up. It's the mania that lifts them. You're not a genius. You're just riding the tailwind of a bull market. That's all. But but the thing with commodities is they can fall out of favor really quickly. Markets can turn on a dime. It's like, even though it takes millions of dollars and decades to get these production lines in, sentiment can change quickly. And a great example of that is cobalt. It's one of the commodities that I actually think people should avoid. And part of the reason is 60 to 70%, I can't remember, it's that band, come from the Democratic Republic of Congo. Now, this is actually not a particularly good country to do business with. It's huge sovereign risk. And yes, there are some Western miners listed there. So you've got some UK companies listed there and a couple of Australian and American companies operating from there. But even then, these companies are having trouble working with the government. And there's sort of a lot of concessions that are being made. Now, this is coupled with the price of it is ridiculous. It's about $55,000 per ton, down from about $80,000 per ton. And it's also like 10 times higher than what it was 3 years ago. So when it's that expensive and that hard to get and doesn't look good in the ESG statements, it's ripe for disruption, because it doesn't. Like, you can't greenwash this.
You know what's interesting? I just quickly jumped onto transparency.org because you know how they have that corruption index?
Yes.
The Democratic Republic of the Congo, it ranks 169th out of 180 countries.
It's worse
in terms of the corruption index.
Wow,
that's it. There's only 11 more corrupt countries than the DRC. So that kind of proves your point.
Look, it absolutely proves my point, and this is going to make anybody with any technology in front of them feel bad, and I've got plenty of it. Pretty much a lot of the cobalt that is mined, that we use, has been mined by children in extraordinarily unsafe conditions. So it's really not something companies, Western listing companies, want to deal with. In that too, science.
But don't we need cobalt though? Isn't like cobalt
so we're working on
a crucial part of EVs?
It is. It is. And that's the problem. And it's because basically they can't clean up the government. I'm sure there was a bit of, let's bring democracy over to the Congo for a bit, but it's not cleaning up the way miners need it to impress shareholders. So what we're seeing now is increasing experimentation with substitution. And manganese is showing promise in this. It's not enough to say we can roll it out, but manganese is proving in most cases that it can replace cobalt. And that goes for about, $3,000 per ton. So it's significantly cheaper. It's extremely abundant, and you can find that across many different ore bodies. So it significantly reduces that sovereign risk as well, which is why, while cobalt, it's got everything, when you're trying to talk about a great stock, it's got everything that makes a great story. But from an analytical point of view, it's ripe for disruption, especially when big corporations are turning their back on it. Or increasingly turning their back on it, I should say.
Yeah, it's fascinating because what you mentioned just there is it's a great story, but when you actually dig into the detail, it's actually quite horrific. I can't even have a better word to use than that. It's awful.
Yeah, it's one of those stories that makes you uncomfortable to discuss, but we need to be uncomfortable to recognize where these things are coming from.
Yeah, absolutely. So cobalt, that's interesting because there are a lot of fanboys for cobalt investments out there. But I like that take on it. I like that perspective, you say, because as we all know, whether one believes in ESG investing or not, which is a conversation for another day, which I know James Early has covered a bit in his coverage of things. And if anybody's, by the way, watching, you can, I think on YouTube, go and check out the Early Advantage, James Early's video podcast. But anyway, I'm not here to plug James and stuff just yet. Talking about talking about more things you don't like in the commodity sector. So, okay, we've got cobalt. Is there anything else out there which investors should probably be a little bit more wary of?
Oh, look, I'm going to be annoying the fanboys of this one as well.
Apart from gold,
Apart from gold. I'll stay away from gold for the moment today. I think I can do this. Lithium. I think lithium is too, it's still very much caught up in the hype cycle of investing. Yes, we need it. Yes, it's important. But for something to grow 500% in price in 12 months, really, can I just point out, that price growth is based on car manufacturers' targets. It's actually not based on sound science. Yes, we are transitioning to EVs. Yes, there is increasing desire for lithium-ion batteries, not doubting that. But there's not really hard science behind it because the data is coming back from people who have a vested interest in telling us that we're going to buy more of these things. The other thing too with lithium is there's plenty of it around in the ground. So much so that years ago it actually used to be a byproduct from mining, and companies considered it waste and they paid other companies to come and get rid of it. What we don't have a lot of is shovel-ready projects when it comes to lithium. So companies that are starting to get lithium projects up and running now and next year are going to benefit from this lithium hype cycle. But eventually, once the market catches on that actually we're awash with lithium, we've got plenty of it, I suspect it's going to come off pretty hard.
Yeah, I've been reasonably skeptical for a while about the actual demand supply data around lithium, that the actual supply that is available and ready to be brought online is far more than the market's probably making it up. I mean, as you're well aware, there are some big players that dominate the lithium production space, like Albemarle, and they have
gotten into it just lately.
Exactly. So, do you know what? It reminds me a little bit of, I can't remember what year it was. Was it 2011? The sort of first or one of the early rare earth boom and busts, where every little rare earth company in the world was listing and saying they had these amazing deposits, and then as the hype cycle played out, probably 2 or 3 at best actually had workable deposits that they could bring into production and then refining and all of that. So it feels a lot like that.
Yeah, it certainly does feel a lot like that. And there's the nuance here as well with like a lot of copper, iron ore and gold, for example, the metals extracted and it's basically turned into concentrate or doré, depending on which product it is. And then it's sent to a refiner. Things with like rare earths, the real value add is actually in companies that can turn it into the oxides that the market needs on site. Not many rare earth miners can do that. They generally just send it off in a very lumpy form and it goes to China to turn into the oxides that the markets need. So if you're going to get excited about rare earths, do that. They're a marginal business anyway. I know you're not meant to say that, but they are actually a marginal business. A lot of them are propped up by governments for a reason. But the companies that are going to actually benefit shareholders in the rare earth sector are the ones that are turning it into the oxides that the markets need, either on site or that have developed relationships with, basically allies for them, countries we're friends with essentially, or we don't have geopolitical risk with, that are going to turn it into the oxides we need.
Just something you mentioned there as well is just the way you're talking about how, you sort of can identify, what to look for with something like rare earths companies. Is there like a magic bullet, a silver bullet that sort of you look for when you're looking at companies and you're like, could be across any commodity, sort of where you think, actually, you know what, this is the trigger. This is what I want to see. This is what we need to see to make this a real quality opportunity.
So the key word here is downstream. This actually became a bit of a buzzword in Australia in around 2019. Look, as you know, Australia's good on the extraction business. Basically, we're really good at digging big holes and sending the stuff in the hole to somewhere else to turn it into something else.
I did good.
Yeah, we're good. We do big holes really well, better than anybody. Although the Canadians might fight us on that one.
You see my backyard, I did great holes.
I wanted to quote the.
I've been rare earth mining in the backyard.
Certainly have. But the key word here is downstream, and that's really what I just mentioned before with rare earths. And that is mining is a marginal business. It's not. It doesn't make as much money. Like, yes, miners make money, but it's not a high profit margin business. The high profit margin actually comes in companies who have invested in the plant and equipment and will turn that commodity into a usable form for the market. And the key word for that is actually downstream. So when you see companies talking about investing in the downstream business, that means that they're looking at the certain process it's going to take to turn, these metals into what the market's inspecting. Now, you would think that I would have a word to throw at you off the top of my head. Cannot think of one for the life of me. I've run out. I have not had enough coffee today. But the key word here is downstream. Companies that are investing in the downstream process should cost several millions and millions of pounds. But these are the companies that are looking for the value add. The other sneaky thing here about that is governments favour mining companies that are investing in local production. So, for example, in the US and in Australia, companies that are spending money on, basically having plant and operating equipment to process these things on site are front runners to get a government handout, or, instead of a loan, they get a government grant kind of thing. So those are the key. That's the key word that you want to look for, because that company that is downstream over just extraction is more likely to get a subsidy from the government.
Interesting. And we all know that if they're getting some government handouts, they're also more favourable to get the sign-offs on the permits and licenses.
We're not meant to admit it, but it's true.
Yeah, well, we all know what they're not meant to admit and what they actually do. So all those little things, funnily enough, tied together. Yep. That's fantastic. That's great to get a bit of an insight as to some of the areas in the commodities sector to maybe think twice again. Think twice about. I don't think I've had enough coffee today either. But then also say looking for those key things, that keyword downstream, when you're looking for investments. I want to throw one more question at you before we wrap up today. And if you had to pick one market, and I personally, I hate it when people ask me these questions, but I don't care because I'm going to ask you anyway. If you had to pick one stock market to play the commodity sector on, London, maybe Europe, the US, Canada, Australia, wherever, which do you think right now is probably the most exciting market that's full of great commodities, investments, and opportunities?
So I would say Canada. Ooh. If you've got the stomach for risk. Some of the tiniest pink sheety speculative punts can be found listed on the Toronto Venture Exchange. So if you have decided that, you don't, it's just this with money, I think that's a great place for really speculative stocks. A lot of juniors go there to sort of prove themselves. You don't want to go into the Canadian over-the-counter market. Stay away from that. That's just too hard to navigate, especially from the distance. But I think if you are into commodities and you've got the stomach for not only commodity risk, but also currency risk, because odds are that you're not a Canadian, I think there's incredible opportunities up there. The other advantage is it's a great jurisdiction for mining, and it's a market that has a lot of private equity money flow into it. There's a lot of cashed up money, a lot of money there looking for a home. And when it comes to their capital raisings, they've generally got to do a capital raising above the actual current market price, whereas in Australia, you can do a capital raising below the current share price. So I think there's a lot of opportunity on the Canadian market, but it comes with big risks, that's all.
There you go, folks. You heard it here first. Get your Canadian markets onto your broker. Make sure your broker's got access to Canadian markets. There could be some wonderful and wild opportunities, but as Shae mentioned, full of risk. But what are we to do apart from look for investment opportunities full of risk? How boring are ones without the risk, hey? Anyway, that's what we're here for. We've run out of time today. Thanks, Shae, again, for your wonderful insight into the commodity sector. Love it. You're my go-to person every time I got questions on this stuff. Thank you, everyone, again for watching. We'll be back again with you next week with another Exponential Investor podcast. Actually, one more thing before we do go. Now, Shae, I forgot to add this in, and I want to talk to you just very briefly about this. You've mentioned recently that we're looking at perhaps a commodity super cycle, and you've got a new briefing coming out. Well, I say new, your debut briefing for Southbank Investment Research, specifically about, is it super spike? Can you tell us a little bit about that?
So super spike. So the whole premise of it is that I believe we are going to see another super cycle. Now, commodity super cycle are actually pretty rare things. There's only been 4 in the past 150 years. So I believe that we're going to see another one. And that's why it's being called Super Spike 22, Super Spike 22. I think that's what I've called it. And the whole idea is that there is unbelievable underinvestment for decades in the commodities space, and yet we're about to go in one of the most resource intense transitions our economy has ever seen. We've talked about, we've got the energy transition happening, we've got urbanization, industrialization. All of these things, in order to happen, are going to require vast amounts of, I couldn't even pronounce the word that I wanted to spit out. So we're going to go with vast, 4 letters, that we need to make this happen. And I think this is going to cause a massive super spike in prices, simply because we haven't spent enough on making sure there is enough in the ground to make it happen. It's a tale as old as time. It's actually what's caused the past 2 commodity super cycles as well, in the 1970s and in the 2000s. And I actually think we are on the verge of seeing history not necessarily repeat, but definitely rhyme.
Yeah, it's fascinating stuff to see just how quickly that demand and those prices can shift in a super cycle, as you say, as we've only seen a handful of times before. And if it comes good again this time around, which I trust in your analysis and what you've been telling me about it, it certainly sounds like that could be the direction we're looking at. Things could get absolutely bonkers very fast. And as we mentioned now, Shae, your briefing, I think, is going live on Tuesday. Everybody, if you want to check that out. And look, I've known Shae for almost a decade now. I think our anniversary, Shae, is March next year. I 100%, if Shae believes this is what's coming, then this is the kind of briefing that you want to make sure you go and check out. I'll be watching it live on Tuesday. If you want to check it out as well, there'll be links below and or around this video somewhere. Make sure you click on it, get your name down to get access to that VIP landing page where you can get exclusive access to Shae's broadcast when it goes live on Tuesday. So make sure you do that, and I will see you there. But again, thanks again for joining us, Shae. Thanks again, everyone, for watching. We'll be back with you again next week with another episode of the Exponential Investor Podcast. Bye for now.